fundamentals, rationalization, and we know that that is very, very partial. So sentiment is a metric of the emotion in the market. I get a sentiment number, which we'll get into every day. Now, people can be entranced with sentiment, thinking that it has all the answers, that if sentiment is low, you've got to buy. If sentiment's high, you've got to sell. It's not that simple. It is merely a reflection of emotions. So I look at extremes in sentiment on various scales of time to try to ascertain if the human emotion about the market is near an extreme. Okay.
All righty. I'm going to go to the next slide here.
So, as I said, sentiment is really the missing link, and yet the sentiment that we have is data, and sentiment data is only one part of the market equation. Now, there are other various types of sentiment data. I've written elsewhere about these other data sets, and I try not to get involved in what they may or may not be saying. I think they're pretty silly, like the American Association of Individual Investors. What does that tell you? The whole point of what I do is to try to predict the market, because that's what real traders and big institutional investors want. What's the market going to do? That's the primary question. So sentiment is not a trading system. It is a powerful diagnostic tool that not many people really understand. Okay.
So Woody, a question that we get a lot is your sentiment data. You've explained to me a little bit about it, but how do you like when you compile your sentiment data? Are there people that go into your say, do they call in? Do they how does that all work? Because that's been a question that's been asked a lot.
Well, that's fine. It's not the most important thing, but the point is as I've written about before, is that I have what I call like about 100 listening posts, and so at the end of the day, I get electronic inputs from them about what they're hearing about the market. So after the market closes, then this sentiment data comes in and it gets compiled, and it's based on the market close. Just as when you look at a daily bar and
right,
S&P cash, you get a daily bar. It's a defined data set. Yes, we know the futures trade at night and this, that, and the other thing. So these feelings come in. Now,
and they also I just wanted to go back. Yeah. I remember reading in your book that these listening posts that you call, they actually it could be just a set amount, but they represent thousands of actual say sentiment readings from people. So each one is then kind of branched out, and that's how the data comes. At least that's what I had. I remember reading from your book.
Well, of course. So let's face it. Someone who's on a trading desk has lived through the trading day. He's heard from or talked to hundreds of people during that day. He has read blogs and websites, et cetera, that correspond to tens or even 100,000 opinions that come into that he hears. So the sentiment data, is like a giant funnel, and it takes it all in. So the point is also, sentiment is never going to be 110% bullish. It can only be 100% bullish at its maximum, right? Yep. So, I mean, it's just pretty interesting. That's why, for instance, looking at the extremes and also the moving averages gives you a sense of sentiment. So I think today's sentiment, for instance, was like 67% coming in today after yesterday's close. You say, well, what good is that? Well, it doesn't tell you a great deal except that it wasn't at an extreme. It's a mildly positive and turns up some of the sentiment moving averages. So, again, sentiment always has to be diagnosed, which is what I do in the newsletter.
Fantastic. So you had mentioned like the AA sentiment reading and stuff like that. And something that we've spoken about that I think is interesting also is that really one of the differences of the data that you collect from your listening posts is that it's been the same, and it's always been the same. And the difference between say your data compared to say some other ones that may be out there are that you have no idea where they're getting their data from. A lot of them have them where people can log in and just put whether they're bullish or bearish, and it's not really consistent with a pattern that you have where you're getting the same exact data every single day from the same say listening post that you said.
Right. Well, I would say it is a consistent process,
right?
And that I've been collecting it in the same way over a very long period of time and diagnosing it. Again, it's the diagnosis. When we get into some of the charts, I'll be able to show you what does the sentiment mean. Again, most people don't go into the diagnostic part of it, but that's the critical part.
Right, exactly. And what I have noticed, I mean, because like I said before we started this, I used to follow sentiment, and I used to get them from the couple other things, and it's pretty much exactly what you said. I mean, what do you make out of the number? You don't, okay, well, if it's at this level, are you supposed to be shorting? And a lot of other, let's say, extremely bearish sites that are news feeds that were out there. I mean, they used to keep pounding the table that sentiment was too high, and the market kept going higher, so they didn't really get that take on it. So
well, excuse me, it's a good point, Gary, because what happens is people are kind of aware of sentiment, and they can kind of hang their hat on it, whether they're bullish or bearish. Oh, this is what it means, or sentiment's this, or sentiment's that. And they haven't really made a study of it. They haven't made a study of human psychology or of the emotions. I went into many major firms on Wall Street to talk to them about this going back 10, 20, 30 years ago. And they're all like, oh, I go into one, Goldman Sachs or whatever, and they go, oh yeah, man, we're contrarians too. We're really into it. Oh, really? Then you go into Merrill Lynch. Oh man, we're contrarians. Everybody's a freaking contrarian. Doesn't make any sense because they don't realize that they're part of the whole ethos of it, and they really don't understand the market emotions. Let's go on to the next one.
Okay.
I think, unless if somebody tiles in a question, let me know.
Yeah. You guys can ask questions whenever you want, just in the question box. So this is basically just a slide of the the database and the filters. So this is actually this is not the most recent sentiment data, but I wanted to just show you a chart as far as what the short-term sentiment looks like. So this is one of the things that they that Woody shows each week is is a short-term sentiment database. And Woody, if you want to add on to that, I have the intermediate.
So we usually send these out at least a couple times a week, and I show the extremes because those are the most interesting. But remember, every single price bar here for every single day has a sentiment. So if I put in for today, it would be 56, and a couple days ago it was 52, and that's not really as interesting as trying to look at some of the extreme sentiments and also with interpretation. So you see the cluster of very low sentiment, 0%, 1%, 6% at the August 24th low. It's interesting when you see a cluster like that, and you see some other extremes here with very low sentiment. Now there are other times when you might get low sentiment it isn't necessarily a price low because it's a different interpretation. The most important thing is the market has to be going down long enough for people to get very, very bearish. Then it becomes more interesting.
Okay, and this next slide is actually showing, this is just a snapshot of the intermediate term because there's two separate charts that are shown. One is the short term where he puts the readings on there, and then we have the intermediate term. So this is do you want to go back?
That's a 10-day moving average of sentiment, which is a little longer time look at the market. And we like to see where the shorter-term sentiment, which you saw before, and this interim sentiment, how they kind of might work together. And again, you can see there was very low sentiment in this measure at the August 25th low, and again the September 29th low.
I have those charts up, moving forward. Actually,
and you know, so that's kind of interesting. And then there's things which I might talk about that could be divergence in sentiment. If the market kind of reaches out to try to make it up to the range highs, which it did here, but the sentiment doesn't quite get up there, that's interesting. So there are different sentiment measures I look at in order to diagnose the market. Again, the whole point is what's the market going to do?
Right, and that's one just from somebody that's not an expert at sentiment like you are. I've learned a lot since working with you, but one of the things that I just get a feel for is where is the short-term sentiment, but one things I really pay attention to is where is the intermediate-term sentiment, because you've said it before, it's the same as a regular technical indicator like a MACD or something, but it's on human emotions. And if things are going long enough, then it just, to me, adds, if we have everybody that's bearish on the markets on an intermediate-term basis, to me, it just, yes, the markets can go down. Obviously, we're seeing that, but it just makes the risk of jumping on a particular short side when everybody is on the side. So I just wanted to throw that in.
Right. Well, again, as I said, it's the missing link. If you're not getting this sentiment and this sentiment diagnosis, and you're trying to trade the market just based on technicals or what they're saying on CNBC, forget it.
Right.
This is a missing link. You've got to have this because it's a very important part of the market, and it's not as simple as people think. One of the things we'll talk about a little further along is how what's happened in the last couple of months of sentiment foretold a bear market. And in a bear market, you get lots of low sentiment because people are turning their minds around differently. Let's keep going here, Gary.
Okay, no problem. Okay, so what I wanted to go into now, Woody, I just put these questions down. We don't have to go through every one of them, but one of the things that Woody does, and like I said, I've been blown away over all the years I've been following with how he's able, his technical timing profiles are able to look out into the short-term distance, could be 2 weeks, 3 weeks, or whatever, but and showing when to expect volatility or some type of turn in the market. And this is what Woody, he calls them the technical timing profiles. So it would, just in a quick word, what would you describe, a technical timing profile? Is it what I just explained, when in the future to expect some type of turn in the market?
Well, sort of. I wouldn't call it a turn per se, because a turn means you don't know if it's going to be a high or a low. My job is to tell you what the market is going to do. Now, the timing is separate from sentiment, but when they align, then you get a higher confidence, and I know you're going to get into this, but supposing that, which I said a week or 10 days ago that the stock market timing profile, very near term, was for a low last Friday. So then you come in and you get some really low sentiment. It begins to build a probability, and then you would add on the regular technicals. Now, here's the point.
Woody, real quick, I just wanted to, we have Paul that's asking a question that,
Sure.
Couldn't low sentiment result in lower market levels?
Absolutely, and I'm going to get into this. That's very, very important. Remember, sentiment is just a mirror of market psychology. And in fact, the preponderance of lower sentiment over the last 6-8 weeks is a tell that market psychology has changed, and that you've changed from people being buy the dip bullish into something else. So that's where, and as I said to clients in the newsletter this week, is that just because there's been some low sentiment here, and I do think this week we'll see some price improvement, that doesn't mean it's a buy the dip, it's an all clear. because once a market turns into a more bearish market, the bounces are not going to be very convincing. So yes, low sentiment can lead to lower sentiment, but more typically if you get an extreme low sentiment cluster, you'll get some kind of a bounce which may be counter trend, but it's certainly not the end all and be all of buying. You don't buy every sentiment low.
Right, Woody. If I can I add one little thing to what you just said is when for the past 3 years or 2 years when we started doing this, what we've seen was and we'll go. I'll show you this in the charts ahead. But before a top was made, we would see anywhere from 5 or 6 different extreme bullish readings before the market would drop, and then when it dropped, it was a quick drop, and then we would make new highs. And what we're starting to see now is we're getting these low sentiment readings, we're getting these bounces that are fast, and then it's going back down again. So as you mentioned, where things are changing, that to me that's just what has stood out loud and clear over this year.
Right, you have to diagnose sentiment, just like you have to diagnose the RSI, the technicals.
Right.
Absolutely. So the point is, this product is focused for people who are interested in the trading over the relatively short term. And what is very curious, if I would tell people, like, what, it's actually not that hard to predict the stock market short term. Well, that's crazy. You see on TV, people give you a 3 to 5 year view. What good is that? I'm able to do it, not all the time, we know that, but it is extremely interesting that there's an opportunity to get inside most of the timing that people look at. So simply put, I've really spent from the beginning 40 years studying time, and it's a vast, vast subject, but one of the things that I do is also parse down various time frames so we can look at a week or 2 or 3 or 4 or 5. I mean, as I published a couple of weeks ago, I'm super bullish the stock market, really, really bullish in 2017. What are you going to do until then?
Right.
I mean, you see what I mean? So the idea here is that we project out the timing so that people have a sense of, okay, depending on how you're trading using options or whatever you're doing, how do I filter when I might expect that the market would be making a high or low? Should I get aggressive here? Should I lay off? Should I get bullish, etc.? So every trader is going to use it differently, but the point is that this product, Sentiment Timing, gives you timing profiles in relatively short periods of time with a degree of probability that is very useful.
Right, and,
so let's look at
for most of the time, I mean, they're really, really good. And there's times that we're gonna, some things aren't gonna go exactly as planned, and that's where we're, one of the things that I had mentioned in the beginning, where it's not, no one's going to be 100% correct all the time, but you're going to be able to put the odds on your side as far as whether to get aggressive shorting or going long or stuff like that. So I'm going to move on to the to our next slide, and this is these are just some examples of let's say previous calls, and it's going to be. I'm going to show you that matrix that I was talking about, but this is from the August 4th. If you could look up in this area here, this is our August 4th sentiment timing report, and what I was what I was explaining about what he's able to predict these reversals, I guess is the best way to put it, because they're not turns. A couple weeks usually in advance on it, and they last a couple weeks, and the market timing on this was that there was a potential trading target or sell zone from 814 to 821, and again, this was published on the 4th, and Woody was calling that the the kill zone. So it was a it was something that I haven't heard before, and it was one of those times when he was very confident with the actual moving down on it, and it was a if we switch slides on this, I'll show you what had happened. And this was the kill zone. This was the period. This was the report that was put out saying to look for the reversal to come sometime between the 14th to the 21st. Oh, I'm sorry. Hang on one second. I got to go back now. I don't know how to switch these things without it. Okay. So so as you can see from the time period that it was the kill zone was there, that's when the market had this extreme drop on it. So what do you want to add to that? I just wanted
well,
to
just that, again, I've been studying the market for a long period of time, so I look for setups and situations. Now, this is pretty unusual, but I did come out with the kill zone, and that it would lead to black holes on the downside. That's another term I use. I also use golden halos in terms of setups where there's a trading and sentiment high. So there's a lot of things that I look at, but this was a great trade setup, and a lot of people did very well with this. So yeah,
right. And again, it was the timing profile that from the 4th that was projecting the move here. And like I said, I've been working with Woody for 2 years on this, and I still shake my head sometimes on the accuracy of these of some of the calls. So that it was one of the best calls I've seen besides the other black hole that you did in September 2014. So it was the same type of move. But all right, so I want to go to the next slide here. And what this was after we had that big move in August, which was the kill zone. And this was our September 3rd report. And what he was looking for in this was there should be high volatility around 917, which it synchronizes, but it doesn't fall in place with the FOMC meeting. And
right.
It should look for it to gather momentum into the 23rd or the 25th. So,
right.
So again, this was 2 weeks before.
Yeah, so basically, it was ahead of time that September 17th came out as a date which looked like a high, which happened to coincide with the Fed meeting, and we would trade down for 10 days after that. And
yes,
and it did. So that's how we got into the double.
Exactly. Yeah. So this was when the report came out. This was the bounce exactly on the 17th, and then from there we saw it come down. So it was, again, just another example of the technical timing. So this was one of the more recent calls, because those, obviously are going back to August and September. Excuse me. So this was on December 22nd. What he was looking for was looking for upside into the 24th. And then from there, it should be corrective behavior into January 5th or the 8th. So the one thing that I saw that was very interesting on this was that we had a series of the sentiment. So this kind of puts everything together as far as with the technical timing indicators that you follow, as well as sentiment. So this is a more recent sentiment data sheet on it.
So from a diagnosis point of view, remember, it always has to be diagnosed. And sometimes what happened, a couple of weeks ago or 6 weeks ago can be very important. So what you see here is a number of these high sentiments. I have circled the 93% bullish, the 90, the 98, 91, 92, is you're seeing a number of high sentiments there without the market going anywhere on the upside. That's very interesting.
Right.
Then you saw the extreme low sentiment back at August 24th and September 29th, which were identified as lows. And look at the market. Look how it bounced back. It bounced really, really well from there. Whereas in the last 2, 3, 4 weeks, we've had some low sentiment, and bounces have only lasted 3 or 4 days. What does this whole picture tell you? It's like a Rorschach blot. It tells you that the market is not trading well, and we've probably entered into a bear market. So that's where the diagnosis, even going back a couple, 3 weeks, can give you that. It's the diagnosis, not just the data.
Right. So if I switch here, this was this is just showing a chart of it. This was the 22nd when we put that report out. Here's the 24th, and I just wanted to go back on, with the we knew we had the technical reversal date coming on the 24th here. And then we had the Christmas break, and then we had that one spike. But remember, what I was saying was, is it safe to be, is it safe to be buying? Should you be shorting or keeping a neutral stand? And we got this spike up. We know we had a very extreme bullish sentiment, and we also had some technical divergences. So from that, this should have been a no, it's not safe to buy, and obviously we know what had taken place with the market from there. So so this is actually our latest report. And Woody, I figured that I just took some things out of there so you can explain. So, because some people have never seen any of this, and I figured maybe you can just go over it and let them know what you see.
Right. So again, some of the same diagnosis I talked about before, that the market was giving an overall, bearish view. However, we got very extreme sentiment coming in last Friday and this Monday, as is seen on the chart on the left, and that the chart on the right, the intermediate term sentiment, just got low enough so that it was at the same level that we saw at the August 24th low. So that's very interesting. That's good to know, and I provided that information to you. However, what I said is that we're in a different kind of market now. The market has changed, and that probably what we would see this week, from this extreme sentiment, is basically some kind of bear market rally, some kind of a up, down, up sequence, and how long it might last. So I think I said up there, maybe up 3 days, 3 to 4 days sideways to down, then another 3 days up. That's the kind of shape or gestalt that might make sense in this context. So that's what it says here.
Okay, perfect. And you could see that now. The one thing that I just wanted to touch on, because it's something that we were going over before, is the series of low sentiment readings that we've been seeing, especially in 2016. But we also have the intermediate term that's low, and we're still not getting those bounces that are being sustainable. And it's we just took out the lows from Monday. So it's going back to that, to what you were saying before, as that the market's changed and not a lot of people have picked up on it yet, and eventually they will down the road. So
right, much further down the road.
Right.
But I also said in the report, which I'm not sure if it's in this text
I took
here.
pieces of it because it was a little bit too long.
So I did talk about how the market, based on the sentiment, should have some kind of a bounce, but then would go lower yet again, in this month. So, my job in this product is to show you the sentiment and to give you the timing profile in a relatively short time frame. So there's a number of nuances that are in the written report that aren't necessarily right here about the timing going out the next 2-3 weeks.
Well, one other thing that I wanted to I thought would be important. I know you have to leave fairly soon, but when we see say a series of say 0% not a series, but let's say a previous low that was made with a 0% bullish reading, or a previous high that was in a 98 or 90, how you use that as important support resistance, because it's a psychological break of it when it happens, because everybody was bullish at that particular time or bearish, and when it takes it out, those it usually sometimes picks up steam when it moves to that particular direction. Is that correct?
Right, that's very good, Gary. So basically, another factor of the diagnosis, which Gary has pointed out, is if you look back in the chart on the left in December, there were a couple of extreme low readings. There was a 1% and a 0%. reading, and it made sense for the market to bounce from there, which it did. But then, on the most recent decline, it went right through those levels very, very quickly. That is a proof. That is a proof of a bear market. That would never happen in a bull market. The buy the dip, you'd never be in trouble. So going back to see when
Actually, I think if you look at the 2015 in September of 2015, we had the 91% bullish, and that was an important resistance area. And once the bulls got through that, that's when we saw it spike higher into the 98% sentiment reading, but also it was close to 100 points higher in price as well.
Right. So this is where the sentiment diagnosis is, again, it's the missing lens. You may be, understand your MACD or this, that, and the other thing, or maybe you got a buddy on Wall Street who tells you what the earnings are going to be or should be, the whisper numbers. That's great. God bless you. But if you're not studying sentiment, and most people are not studying sentiment at all, let me do it for you. Because the sentiment and the diagnosis is extremely important. It's the missing link. It's a lens that you want to have. And again, it's said here, and I said it in the last couple of weeks, is, you're taking, this is bearish behavior. We're going into a bear market paradigm.
Right. Does anybody have any questions for Woody before I get into the technical aspects of things? Because I know he has to, he's going to have to leave in a little while. He has another appointment that was set up on it. So if he can answer any questions for you guys, and then if not, then we can let him go to the other appointment, and I'll go into how I use the technical analysis combined with the sentiment and the technical turn dates. So if you have
I can stay till 3 anyway. So
question thing. What's that, Woody?
I can stay till 3.
Oh, okay. I wasn't sure if
I figured so.
you needed to go a little bit earlier or not. So
yeah.
Okay. Well, that's pretty much this is the latest report that we've done, and it's the market's been kind of crazy. I know that we knew that the 1900 was important to hold for things to be able to continue higher, and we today things just pretty much fell apart. And I mean, the thing that I always find kind of interesting in it is that they're always trying to blame it on something. So now you have a lot of the talking heads that are coming out and saying it's oil that's bringing the whole markets down, and that kind of stuff. Was that all of the bounce that we can get from the low sentiment we got yesterday or Monday? So a question was asked: is that okay, here we go. We got a couple of them.
Okay.
So let me.
Yeah. So okay.
Okay, so these are the questions. That one. Yeah. So
Let
we
me
have
answer the first one first.
Yeah, Jerome is a short covering a bear rally. Well, yeah, that's what basically it would be considered. Because if it was a bull market, Jerome, I can answer that. If it was a bull market, a short covering is going to continue higher. If it's a bear market bounce or a rally, that's where they'll find support at a certain level, bring it up, and then bring it through a resistance level, cause shorts to cover, and then typically what happens in a bear market is that once the shorts are done covering, the market will then continue down in its level there. So, and then Paul asked, was that all the bounce that we can get from the low sentiment we got yesterday and Monday?
Well, it was a good bounce. Do we know exactly? No. Again, as I pointed out, buy the dip in a bull market is different than buy the dip in a bear market. One should not be looking for a huge, huge rally here. But I still think this is potentially a compound recovery where we've had a recovery. Now the market has turned very weak, as you can see here this afternoon. Well, let's see how it closes. Maybe it's some kind of a B wave and we get another rally attempt, for 3 to 5 sessions. That could certainly happen. We don't see the close yet, so it's a little bit unclear. However, let's be clear is that, this market now has to be viewed through a bearish lens. And I don't think people realize how far down this market can go and for how long it can go down. That's a big, big picture thought. But meanwhile, there can be lots of little trades to do. And as I said in the piece, there's another place for a low in the next few weeks where then we might get, maybe a better rally. It could be 10, 12 sessions, et cetera, et cetera. And then as we go out a little further in time, I'm looking at a great, great golden halo opportunity to sell into. There's lots of opportunities that are coming in time if you're a trader.
Right. That's one of the things that I found kind of interesting, and we've seen it when we were heading higher. Is that I think it was Monday that we made that low down at 1900, but then we rallied off that low and closed up 3 points, but the S&P was down 20. So when the day closed, it's only showing the S&P up 3 points, but it had rallied 23 points. So then when it added another 15 on top of it, it doesn't really seem like it's any type of bounce. But when you looked out from the low to where it closed, where the high was, it was almost 48 points in 2 days. But it never felt like that because what the S&P did was just make up all the losses that it had that day.
Right. So it looks like it looks like a weak, like it was a rally, a recovery rally. It looks fairly weak. That's what it looks like. Now, one of the things I take an issue, and people often say to me, well, the stock market's really kind of crazy, isn't it? Yeah. Not really. The stock market's never been crazy. It's just an absolute accurate reflection of what's going on.
Right.
It's never been rational. People think, oh, it should be doing this, or it should do that, or it's wild, or it's crazy. It is what it is. It's a mirror of psychology, and if you look around the world, or you look at human beings, the irrational element, the emotional element, is always there. Even if somebody says that they're always polite or this or that. I had a guy I almost went into business with once. And he told me, he said, well, I never get mad. I've never been mad. In your whole life? Have you ever taken a leak? I mean, come on.
Right.
This is reality. Markets have a very important irrational component all the time.
Right. We have another question that Lewis asked. It says, how do you use the info to stand if the S&P closes below 1900 today? What would you, is that going to be important for the close on 115 at 4 p.m.? I don't know if that's.
Well, I think the close. I think the close is, obviously is always important. And there's still a lot that can happen between now and the close, but we probably will generate, if we do that, a pretty low sentiment number for sure.
Excellent.
Now one of the things also. There are so many things that I do, I couldn't possibly go into everything, but it's important in terms of this whole idea of market emotion and market mirror is I watch a lot of financial television. Well, why would you do that? I mean, because it's a mirror of the market, and most people watch television to find out, what's going on, to get information. I watch it for disinformation, and I'm practiced at it. So you can do a kind of facial diagnosis on the people who are reporting the news because they're just megaphones. They don't really know anything. I mean, I could give you a chapter and a verse on that. But it is always interesting to me when I watch these talking heads, like as we'll see we get into the close or whatever, you can tell if they're freaked out or not. That's pretty interesting. And there are days when the market is up. When the market is up, they're all joking. They tell funny little jokes about this, that, and the other thing. It's extremely interesting as an ancillary tell of market psychology because they don't want the market to go down.
Right.
In fact, there are certain stations, and I'm not going to, stations where, they're prohibited by law per their contract not to be bearish. They're not allowed to be bearish. They can't put on a bearish position.
Right.
So it's very, very interesting to watch.
Excellent. Hey, Woody, there's another question from Lewis. He wants to know what's the significance of the current pattern that the VIX trails the market. Today, the X price is down. The S&P price is down 50, but the VIX is only up $3, where it should be closer to 5. Do you read the VIX at all?
Of course I do, and you know, Lewis is a wonderful trader. I happen to know him a little bit, and I don't know why he's worried about that. You know, because all he really cares about is Friday. That's a little inside joke, but yeah, I think it's interesting. I thought that, you know, the VIX looked like it was a little bit weak, and even, you know, today with this break, it's not responding that well. So that is to me a little bit of a tell that even if we close weak today, I'm not sure we're going down 300 tomorrow. You see what I mean? I mean, we may close today down, you know, 265, and then tomorrow open down 50 points and rally or something like that.
Well, that's
so I
look at
everything.
I had actually read from a couple people, and it is a good question, Louis, because so many people are looking at the VIX not being at 50, where it was the last time you know, the S&P was at these levels, as there's still another, you know, the S&P still has another 100 points to go to the downside until the VIX gets back up there. Do you read it like that, the VIX, or do you not? You look at it a different way?
Well, you know, there's a couple different ways to diagnose. It's a little bit like sentiment. I mean, it could very well be that it's just that traders are ignorant of how big the market can break, of what the uncertainties are. If they knew what was going on, that this was the start of a major bear market and there was going to be no relief, etc., they probably should be bidding it up, you know, another 5 or 10 points higher now. But the point is, they're not at the moment. So that leads one to the potential interpretation that there is maybe some relative stability in the next, you know, 2, 3, 4, 5 days that's going to occur.
Excellent. Excellent. I know. What real quick, I just wanted to let everyone know we're probably going to run a little bit over it. I'll go over my slides after Woody's done answering questions, because I think that's the most important part right now. And then you know, whoever can stay on, it's my part's only going to be about another 8 minutes, but it's going to just show you how I use the technical aspects of it. But I think it's important, since Woody has, you know, another 9 or 10 minutes before he has to go, you know, to keep answering the questions, because he's really the master of sentiment timing and what we do, and we want to answer as many questions as we possibly can.
Yeah. So that's great. Yeah. Well, questions are very good, particularly from Lewis, who, as I said, is a bit of a market genius.
Excellent. Welcome, Lewis.
As he explained to me.
Yeah.
But let me just say that again, you know, we don't have all the answers, but this is a unique service that focuses on things that no one else focuses on. I developed a lot of these things myself. Again, I've been studying for 40 years. We have a good record of diagnosing these things and looking at them, and I can just tell you that if you're trading the market, you want to have a sense of where the sentiment is, what it means, what might happen in the next week or 2 or 3, etc. And I can also tell you that as I look out a little further along, there's going to be some great trading opportunities this year. So, you know, you need to be following it.
Right. Well, one thing that I do want to let some people know, because Woody and I have been talking about it, where we may be doing you know, with our regular subscribers, a little round table once, you know, every other week or whatever like this, where you guys can ask questions to Woody, because I think it gives it, you know, he explains things better than, you know, he knows it. He created this stuff. So it's going to be something that, you know, where we're doing this webinar right now, it may be a 20-minute little round table that we do, and we've been discussing that. So that's something we may implement into the whole service, where you can ask Woody questions and stuff like that. So, okay, here's a question now. Woody, do you cover any other markets, gold, bonds, oil? That's from Mark.
Right. I look at everything. There isn't anything I don't look at. But this particular product is generically what is happening with the market, etc. So we look at the S&P 500, and you know, if you're trading the Dow or whatever, you can infer from that what the generic situation is. But I don't comment in this particular product on those other asset classes. But I look at everything because my job is to diagnose what I call financial culture. So I look at the DAX, very important to look at. I look at the EEM, the emerging markets, to see what's going on, if it can help give a better S&P understanding. And so there are nuances from those other markets that tell me things. So I think it's interesting, don't you? Like last year, you know, the DAX got creamed big time, and our market was like the strong market and held up. But what if that switches now, and our market is actually, the S&P is going to be weaker than Europe? That's pretty interesting. That's something to look at. If indeed we're really starting to trade a lot off China, which seems to be occurring, then I'll be looking at the FXI and other Chinese indices to see if there's pattern setups there, because if it looks like there's a big break coming in Chinese stocks or a big rally, it could very well influence our market if other things are set up. Another key thing here you see with the commodities in general is that basically the dollar has been bid. It's still strong within its range, and until we get a dollar top and a reversal of some type, particularly with news, is that is going to create headwinds for commodities, which continues this gestalt of weaker emerging markets, et cetera. So I'm looking at all these things, but the bottom line is, I mean, these people who write 20 or 30 pages discussing this could happen, that could happen, how do you do, what do you say, who do you see? I try to do in a pretty short pieces of writing, like what I think is going to happen over the relatively short term in the financial culture and in the U.S. markets. That's what this is.
Hey, Woody, there's another question, and actually, I know the answer to it, but I'm gonna let you answer it, because you've mentioned this for the last, I think, 4 or 5 reports that we've done, and it says, does electing a new president have any bearing on the prediction that 2017 will be bullish?
Yes. Well, you can see that this whole election situation is raising a lot of turmoil. You see it in financial culture. There's anything that's happening in culture affects financial culture, affects the markets. So all these question marks, is it going to be Trump, is it going to be Clinton, whatever, are like, they're negatives because they introduce uncertainty. And I think the further we go along in this election process, the more potential there is for uncertainty based on the political change and the political rhetoric. And again, all these politicians, you know, they're specialists in negativity, right? So they're promoting negativity. That's their job to get elected, is to badmouth other people. So they're projecting negativity onto Wall Street, onto all of us. We hear about all the negative. So it definitely is a negative influence. And I think we'll probably see, as is typical, when we get into the third quarter, that we could get a setup where things could get really, really nasty.
Excellent. Do you see any chance that this bear market could break the 2009 lows and retrace the whole move since then?
Okay, that's a great question. Again, and I'll answer it as best I can. But again, the purview here is, what's the market going to do in the next couple of weeks? When's it going to be the next high? When's going to be the great shorting opportunity in Q2 to get, et cetera, et cetera? Those are things that are really most useful. However, let me say this, is that I do think that the market has proven that it is bearish. Looking at the SEM and everything else, and look what it's doing here today. It's proven it's bearish. Chances are that it's more bearish than the pundits realize. Therefore, if it's a large-scale, very large-scale corrective market, then yes, everything from 2009 can be retraced. One would look at the typical retracements from 2009 to here, or one could go back further in time and go back to prior lows in 82 or whatever in terms of retracement. I do think it could be large-scale. But again, You know, those are the sorts of, I mean, the lows happen at the end of a move. The really big lows happen at the end of the move. What's interesting here is that this is the beginning of the breakdown out of the complacency. This is the beginning of the move. So this is like this is an igniter. You know, this is like first leg type stuff. And again, most people don't get it on a first leg down, how bearish it is. We've got to have some kind of a rally, interim degree, and then you could start, you know, some kind of a third wave or whatever, et cetera. And then people may really recognize the problems. So,
well,
yeah,
one thing that I would I'll bring up that I think is pretty interesting is that during when we had the big break in August, it was one of the things that was said was, you know, there's a lot of questions about whether we are entering a bear market or not, and what you had explained to people was that whether we're in a bear market or not, it's something that will, you know, nobody's really going to know until 2016 whether we are or not. So you knew that we were going to get these bounces to kind of keep people in this market all the time, and that's pretty much, you know, going right into the end of December. I mean, we were going back towards you know, towards those highs again. Everybody was predicting 2150, and nobody knew that things had changed, which you had mentioned all the way back in August that they have, but nobody would realize it until, you know, sometime in 2016.
Well, some information is more useful than other information. Now, I'll tell you, Gary, you and Lewis, if Lewis is still listening, I'll tell you something I probably should never say, but here it is. I already know when the market's going to top and bottom this year. That's my job. It wouldn't do you any good if I told you. Just like the black hole in 2014, I knew where that was going to be months and months ahead of time. But there was no point thinking about that or putting on a trade until we got into the September before, and the trade was only 3 or 4 weeks. That's where you made your money. So, like I said, if I said to you now, you know, that the market's going to go down, the S&Ps are going to go down to 600, you know, you'd be like, oh my God, I'm going to buy as many puts as I can and get my brother-in-law, et cetera. And that probably would be a losing trade because, you know, options have a declining value over time. So we take it, you know, one setup at a time. That's all we can do. That's all I can do, and that's what we're offering here. Okay, well, I'll let you go then unless there's another question.
No, right now that's about it. Paul had made a comment. I'll forward it to you. He's a subscriber, so I'll forward you the comment just because it's more towards the newsletter itself. So I don't think it's going to help some people that you know aren't don't read it. So I'll forward you that back into in an email format. But Woody, I know you have to go. I think it was fantastic, everything that you had talked about. Now what I'm going to do, if anybody can still stay on, I'm just going to go through you know, combining everything together with the you know, using the Woody's technical turn, let's say reversal dates, with sentiment, and then just using regular technical analysis, and then I'll show you our special offer at the end. But Woody, thank you so much for everything.
Don't forget the special offer. Okay,
yep,
cheers.
At the end. Bye. Take care. All right. Bye. So let's go on from here. Now this is just more how I use everything with the you know, with our actual. Hang on 1 second. Let me just do this. Okay, so I'm going to move on to the next screen. Let me just bear with me 1 second. Attendees. I'm just trying to be able to, okay, all right. So anyway, so let's move on. So I showed, Woody had, it was a fantastic job that he showed with everything on the, you know, that was going on with the sentiment and stuff like that. Now, what I want to go over here is the how I combine regular technical analysis with our regular. Hang on, I just want to. Hey, Woody, can you mute your your mic? I don't know if you can do that on there. I'm just trying to find it here. I'm sorry, I'm a little bit confused on this thing. Okay, let me pop it out. Let's see what that is. Woody, mute. Okay, all right, so let's go on. So basically, what I do now is we put everything together, and the technical analysis part is the, where to look to, for the possible reversal that we're looking at. And again, they're not always going to work, but when you have your technical turn time as well as your sentiment, often more time, like I'm going to say it's in the above the 80% range, you're going to see the turn that's going to happen. So the way that I do it is that you can, just regular technical divergences is when, we'll say a MACD price oscillator is moving up or making higher lows as the S&P is making lower lows, and the vice versa is a bearish divergence is when they're making lower lows and lower highs, and then the S&P is making higher highs. So to show you, basically it is, it's the same thing. When I use my technical analysis, the first thing I'm looking at is time, and that's when Woody's expecting the reversal to take place. The second thing is I try to match up sentiment to make sure that things are going to, are lining up with the time part, and then price is the technical analysis as far as where it could reverse. So this was the black hole that Woody had talked about. This is going back into September 20th, and this was the turn date. This was mentioned all the way back in this area here. But what now, the way that I'm explaining how I use it, so we knew the turn date was coming on the 20th. This is the bearish divergence where you can see the S&P was making higher highs, but the price oscillator was making lower highs. So that's your technical divergence. You can see this is the trend line, and from there we had the big drop. So that's what I'm talking about, using technicals with the sentiment part. So one of the most recent calls that we just went over, and I think this is a pretty easy way to show you this, is that Woody was looking for normal upside into the 24th, and then corrective behavior into the 5th or the 8th. So, come on. Okay. So here you can see, here's going into the 24th right here. We had the price oscillator that was moving down, so it was making lower highs as the S&P was making higher highs. The resistance zone was going into, this is just a regular fib retracement here, from 78% retracement all the way up to 100%. So this would be the area that you would be looking to possibly take a short position. And from there, we all know what happened was we got the spike up on the 29th, and then from there, everything went straight down. So that's what I'm talking about as far as using technical analysis combined with time and sentiment. So the current markets, the matrix, our matrix setup. So we were looking for upside tries into the 24th, allows for the weakness into the 8th. Remember, we had the high sentiment that was going into this. So we knew we had the turn date, we had high sentiment, and on as far as right now, if we look at where sentiment is on an intermediate term basis, it's extremely, extremely low right now. But here's the thing. This is our support zone where we actually broke through this. So now the next support zone that you want to be looking for would be anywhere from the 1900 down to the 1875 level. So we broke through it. I'm not sure exactly what the low was because I have my screen on here. I think it was 1880 or something to that extent. But we have bullish divergences right now. We know that we have sentiment, if I go back, at extreme low levels. We know we were looking for weakness into the 8th, and if you remember I'm not sure which slide it was, I think it was here. Okay, so, no, that's not it. Bear with me one second. Okay, so we're looking for a recovery possibly into the 22nd. So we know the time period. We're looking for some type of low. Obviously, it's a bear market, so these bounces are going to be quick, but it's they're going to fail sometimes, and that's what we're learning right now. But we have we have the low sentiment. if we look where this is, I did this before I put this webinar together. So obviously the S&P was here and now it's all the way down here right now. But we're in the support zone. We're very oversold. We have bullish divergences and sentiment is extreme low, as well as, we're looking for a technical turn into the 22nd. So the question that would be asked is this, is that would you take it as a safe time to be aggressively shorting this market? And to me, even though the market has continued down, it's not that time to, you want to be getting short when you have sentiment that's high, when we're at resistance, not at support. And as much as, yes, we can continue down, we're at periods and the door is open for some type of short covering rally. It hasn't hit, and the rally that we saw off of these lows at 1900, it was 50 points, but it didn't feel like 50 points because a big part of the move was made just recovering Monday's losses. So it's one of those things that I still, as much as I was expecting higher here to get into the resistance zone, we headed lower, but I still would not be comfortable shorting for the reasons that, A, we have bullish divergences. We're very oversold right now. We're in a support zone. We have sentiment that's low, and we are looking for some type of recovery bounce, whether, it be fast or not. So this is the current state. That was a 60-minute chart, and this is our 15 minutes. So this was a bullish wedge. We broke through it. What happened was we ended up coming back down and retesting these on it. This was the original pattern that I was looking at and saying, okay, there's a chance that we're just making an ascending triangle here. But obviously we took that out, and we took out the 1900 level, so that gave us a little bit of panic low. But in my morning notes that I put out was, we had a little bit of a bearish divergence, and we were pretty oversold. So I meant overbought on a 15-minute chart. So there was a chance we could take a breather. I didn't really see the down 50 points today. That wasn't really in my my game plan. But in any case, it's still, it doesn't change the fact that we're still in a support zone right here, and everybody's bearish on the markets. So it's as much as, yes, we can continue lower, I just think it's risky piling onto that trade right there. So is there any, I guess, and I know that Woody has taken off, and there's, but if anybody has any questions as far as, how everything works and stuff like that, because what we're going to be doing, it's for a limited time. We are going to be, we're doing our, first month for 50% off, and then it's really for everybody that's on this, but we're going to be sending this recording out to everybody and making the same offer. I know we had about 250 people that had registered for it, so I know some people couldn't make it. But in any case, he's predicted over 1,400 S&P points since September 2014. And it's probably more than that now. And these aren't exact buy sells. So let me just make that clear. What I was going by was when if he was looking for a technical reversal on a specific time period, and it dropped the high and the low. So but the thing is that it's still 1,400 points and this is just going through September 2014. And when I'm going to put the link out there, and you can see it, but you can actually see these reports that that these calls were made. These aren't we're not just fluffering these things up for that. So hang on, I'm just looking. I don't, Lewis, I'm not sure if we can give an exact what to look for on by Friday at 4 p.m. I think a lot of it has to do with how things closed today. But we're talking 2 days that we got Thursday and Friday at 4 p.m. So where do we think it's going? I mean, honestly, we've seen these rallies. I mean, we just saw it from Monday, in Tuesday, it rallied 50 points. So if the bulls can, get some mojo and try to rallied us a little bit. I mean, they go, when it moves up off of these short covering rallies, it moves really, really fast. We just, they were pretty much selling into this rally, so it's pretty tough to say exactly where things are going to be at 4 o'clock on on Friday. So, are there any other questions that are out there? Did you guys? This is really our first one we've done on our own like this to you guys. So if it's something that was helpful, I think we're going to continue to try to do these at least once a month for you guys. And like I said, I think one of the things that we're going to be incorporating into our into the regular service is doing a round table, every other week or once a week. We have to figure that out, but it's going to be in this format where you guys can ask questions about the current the reports that are out, where you see things going and stuff like that, and we'll try to answer them as much as possible. But right now, I'm sorry for that this went a little bit longer than expected, but the link for, let me just do this, so I'll put it into the room here, but I'll send this out to everybody. Come on. Okay. So I'll send the link out to everybody, but here is that discount link right here, so you guys can, alrighty, let me, hang on one second. Alright, this is paste and it's sent to all. So this is just a link that's going to go to everybody. But I don't have an answer for you, Lewis. I don't know where the S&P is going to be at 4 p.m. on Friday. I don't think anybody knows. It's tough to say on that. But I mean, if I knew, I'd be putting a real lot of money down on it. It's just it's impossible to say. I mean, you could see the S&P back up at 1950 by Friday. It's just at this particular stage with things, we just know that I don't believe it's safe to be really I would say aggressively shorting this market. Get your short-term outlook on. I'm not sure if I understand the question. How can I? Well, but that's what I'm saying. I mean, to use our I would say our reports are more broad-based than where something's going to be at 4 o'clock on Friday. That's what I'm. What I'm saying. To me personally, I would, if I was going to guess, I was been wrong this week, I'll tell you that. I would guess higher, but I don't, I just because of based on what I'd said with the support there, with sentiment that's low, but we're in a different market right now, is what he was explaining, where, the sentiment, even though they're low, we're going to get quick bounces off of it. Well, I guess what you can do is, it's but not in 2 days. It's predicting the markets is something like this, Hendricks, is on 9, hang on one second, I'm just moving this over, on 9/3, saying that there's going to be high volatility on the 17th, and on the 17th the market going. That's that's pretty much, there's not anybody out there that can pretty much do what he does with these types of calls. But knowing that on September 3rd that there's we're looking for a top on the 17th, and then it drops 140 points. That's what I mean. I mean, predicting where the market's going to be from here until the next 13 trading hour, or whatever, not even, let's say 10 trading hours. It's too hard to say right now. That there's me personally, I would think it would move up, but it's tough to say. But what we do, it's basically giving when to expect these these turns. On August 4th, it was to expect a drop on the 14th to the 21st, and the S&P dropped 240 points. That's the stuff I meant. The moves from now till Friday, it's tough to say, but we're at support. We know sentiment is really low right now. We know we're in a period that we're expecting, some kind of reversal to the upside, but as Woody explained, we're in a bear market. But these bear market bounces go fast. So I meant to say where it's going to be on Friday. I don't really have an answer for that. But that's what we do is give you this kind of information, and you have probably one of the best market timers in the world that's letting on the 16th there was a top on the 22nd. This is when this report was out. This was the 22nd, and it drops. So that's the kind of information that you're getting, from this newsletter. It's not a trading newsletter as far as you're going to, the market's going to be at this particular price on Friday. It's just there's a lot of other sites out there that that do stuff like that. It's just not what we do. We're more, is it should you be looking to short the market or go long the market up here? And at this time, I just remember everybody that was basically on the news had a price target at 2,200 on the S&P, and if reading the newsletter and what he was saying, you would have known that you should have been shorting this move, not going long or buying into it. So, any other questions? Or, and again, Lewis, I'm sorry I can't answer what it's going to do as far as what's going to happen on Friday. I wish I knew. Like I said, I'd go put $20,000 on the futures on the S&P to go up, but I just don't have that answer on it. So, but well, listen, I appreciate everybody staying on. I'm sorry this ran a little bit long, but I think it went pretty well, and we had some fantastic questions, and hopefully you got to know Woody a little bit more. And I'm going to be sending out a recording of this, and I'll also be sending out the special pricing. And with that, if there's no other questions, that does it for this webinar.